If you own apartments in Southern California and you feel like taxes are eating your cash flow, this video can put real money back in your pocket. Because most landlords are depreciating a building the slow way over 27 and a half years, when a large portion of that cost can often be accelerated in 5, 7, or 15 years, and sometimes even front loaded into a single year when the timing is right. Hi, I'm Kris German with The Apartment Dealer. Quick favor before we jump in. If you own multifamily in Southern California or you're actively working towards it, subscribe and turn on notifications. This channel is a playbook for apartment owners in our backyard with the real numbers, real rules, and real strategies that don't show up in generic real estate content. Now, today's video is one of the bonus sessions we recorded for our personal clients during our Apartment Owners Educational Luncheon campaign, and it's now being released publicly. I'm sitting down with Stephen Hall, my personal tax professional, who's an enrolled agent here in Glendale, California, and he's also a real estate investor himself. Steve works with clients across the board, including high net worth investors, and he's not guessing. He's in the tax code, in the numbers, and in the real world application. In this session, we go deep on cost segregation and bonus depreciation. What qualifies, how the studies actually break down a property, when it makes sense, when it doesn't, how investors use this strategy to offset taxable events, improve after tax returns, and keep more of what they earn. Stay with this one because once you understand how this works, you'll look at your next remodel, refinance, or purchase very differently. Let's jump in. So Steve, welcome back to the show.
Thank you.
So when we were last together, I guess it was almost 2 months ago, as promised, you said, hey, why don't I come back? Let's get real deep into the numbers here. Let's get math heavy. When we were upon our discussion of bonus depreciation and cost segregation studies. So we're going to pick up the video or the interview from there. For those of you that maybe didn't watch the first video where Steve was giving us an update on all things tax related, I would definitely go back to that video first, then join us here where we're going to pick up again our conversation, cost segregation studies, bonus depreciation, all important for 2025. So Steve, what do you have for us today?
Well, thank you, Kris. I'm excited to go into a deeper dive of what a cost segregation study entails. So to make it really simple, I'm going to play a quick 60-second video here for everyone to understand what we're going to talk about. And I'll freeze some of the frames because then we'll do some deeper dives as we move forward through this educational training.
Okay.
The Next Generation Cost Segregation Study. Cost segregation is a tax strategy that has been used successfully for years to help property owners lower their tax liability by accelerating the depreciation on fixed assets, like an office building, through properly identifying every component of that building as preferred by the IRS. But is there more to be found? Engineered tax services like Next Generation Cost Segregation Study looks beyond accelerated assets and into separate building systems, tax incentives for energy efficiency, disposition of items no longer in use, charitable deductions of materials eligible for donation, accounting for repair and maintenance costs, and even reducing liability insurance premiums with a detailed engineering appraisal. With cost segregation, instead of a $15 million property having a tax write-off of only $384,000 per year, the tax write-off could be nearly $1.2 million per year. Think of an office building like a tall box that holds many individual blocks. If you pull out the separate building systems, like taking a block off our building, those components can help property owners increase their annual write-offs. Building systems include fire protection and gas distribution, the elevators or escalators, the lighting, electrical, and HVAC systems, just to name a few. And other assets like landscaping, flooring, cabinetry, and special lighting and electrical would qualify for shorter depreciation than the building itself. Having this detail in one report creates a valuable tool for property owners to ensure IRS compliance, optimum depreciation, and additional write-offs each and every year. Real estate can be the best investment for wealth preservation when tax rules are applied.
So basically what we're going to talk about today is this right here. We're going to show examples of how this gets broken up in a report. So that way, if you're a landlord, you'll have an idea of what to look for and to break it up. Because as you heard in that video, You could literally, instead of deducting multifamily assets over 27 years, we could literally accelerate it in 7 years, 10 years, or all in 1 year. Because as of July 4th, because of the big, beautiful bill, we're allowed to accelerate a lot of these deductions now in 1 year versus over time. So we're going to go through the mechanics of how that works. And Kris, I'm going to pause here if you have any questions so far.
No, I'm good. I guess no, I do have a question, but I'll share it once we get further along.
Okay. So here's an example of what we're going to talk about is the goal here of a cost segregation study is to identify all construction related costs that could be more quickly depreciated over these time periods, 5, 7, 10 years, and 15. Then we classify them if it's a commercial building from 39 years and if it's residential, 27 and a half years. So we'll want to accelerate those timelines. And these are the items that can be accelerated, which is landscaping, parking, specialty lighting and plumbing, flooring, millwork, windows coverings, partition walls, cabinetry, and wall coverings, as an example. And it could be any type of property that qualifies. For example, I've got clients that own, franchise buildings that they lease out to your Popeyes, your McDonald's, what have you. That would qualify. Those buildings will qualify. It could be new construction, a new home that you're renting out, or a new Airbnb, short-term rental, a new apartment building. It could be a property you just 1031 exchange it into will qualify, as well as if there's a step up in basis, let's say a spouse passes away and there's an inheritance, we could accelerate some of that depreciation in 1 year as well, post estate planning, post death. We talk about 1031 exchanges. It's selling a property with a large gain. So if what I've had done with some clients is they'll sell a property with a capital gain, but they don't want a 1031, we'll just accelerate depreciation from another property to wipe out that capital gain. So there's vehicles here that you can do. And so, like I said earlier in the call, as of July 4th, under the One Big Beautiful Bill, we have 100% depreciation again. And before that, it was for 2025, it was only going to be 40%. So thanks to the current administration, they reset that 40% number to 100%. So we could take a larger deduction in 2025 versus, so for example, if you have $1 million depreciation deduction, that $1 million depreciation deduction, we could deduct that full million. If we do a cost seg here, but if this big beautiful bill did not get passed, then we would have only seen 400,000 of that million. So this was a substantial change to occur for everyone here. So and this allows us to go back for any property that was acquired after January 19th of 25. And this program will last till 2030. So we have plenty of time to plan accordingly with this system. So I'm going to show you, I'm going to do a deeper dive than this sample, but here's an example of a building that was purchased, let's say April 27th of 23 for $1.7 million. And what they're saying here is the land's $350,000. And the amount of the purchase could be subject to the cost
Improvements. Yeah.
4 million, right? Well, without the cost seg in this example, only 36,000 is deductible every year, but with the cost seg, we're looking at 470,000 in deductions. So they're able to break up different components of it. And so we're gonna go through a deeper dive what this all means shortly, but I just wanted to give you a high level viewpoint where when we do the cost seg, we could accelerate all that depreciation in 1 year, like the $76,000 example articulates, versus a traditional $387 or $9,000 example here. So that's the good news. We can front load it. And then these reports are very detailed. They're going to show engineering details in this example. You'll see the cabinets, how many cabinets there were, what was a base cabinet, and what unit was it in. And so you'll see here, they break down the cost for each engineering component in the property, all the way down to the wire or copper or the electrical panel of what's inside.
And obviously, this is a third. It's not the owners doing this, so this is a third party you hire to prepare this report, and they're the ones that are breaking down all these calculations for you.
Correct. So this is important. If you're a landlord, you've had the building 20 years, don't sweat it. Just give the third party we'll talk about Well, you give them your property address, they'll take pictures of the property, and then based on the IRS standards and what's acceptable, they'll break down what can be deducted and what cannot be deducted for you through their software. So that way we can get the sophisticated breakdown of what needs to take place. And that's going to be helpful. We're going to go through more details shortly. So, question is, does this work for everyone? The answer is it depends. If it's a if you're a real estate professional where you spend over 50% of your time in the industry and over 750 hours a year, we could take the full deduction regardless of how large it is in the year that you want to claim it. But if you're both executives, let's say working at a doctor's office in healthcare, you'll be considered passive, where those losses that you take from the accelerated depreciation can it be absorbed against future profits that you have on your books. So, and then the category that everybody talks about that's really popular these days is if you're in healthcare, let's say both husband and wife are in healthcare, you can still deduct those losses if you are in materially participating in a short-term rental like Airbnb. So if you own an Airbnb property or a fourplex that's all Airbnb'd out, then you could claim that as a as an exemption from that 750-hour rule and be able to deduct those losses anyway for the short-term rental area of industry. So what happens is everybody says this is great, but Kris, Steve, what happens if I capture all this and I do it, then all of a sudden I sell it. Well, if you sell the property and you abandon the property, you could either roll the 1031 exchange into another property, or you have a partial sale, which uh, can trigger a tax. So we're going to talk about how ways to mitigate that uh, in this presentation here. But I'll pause here, Kris, if you have any questions so far.
No.
Okay, good. So here's an example of a building, a house. It's just a live cost tag. I just blacked out the name of the client. So basically, this is a 66-page report that we received for this property. And the person paid you know, 431,000 for the building and 107,000 for the land. So what is that total? They paid $539,900. And as a result of the study, they broke the property up into three categories. They said there's $98,000 that's in 5-year property and 15 and in the 15-year property there's $40,000 worth. That's in 15, and the remaining that's in that regular 27 and a half years. So what they did is as follows. They created this chart, this very detailed spreadsheet. And so here's all the 5-year property that was occurred. In this example, you'll see they broke it down to the penny, literally. $10 in direct costs, $3 in indirect costs, plus the price, cost of the equipment, etc. So the reason why I'm bringing this up is that this software will generate a report to break down all that 5-year property that we just talked about that keeps going down here to this line of electrical work, ceiling speakers, TV connections, ceiling fans, the electrical conduit going into the walls, the kitchen equipment, dishwashers, refrigerators, telephone connections, fixtures on the wall, laundry washers, TV connections, accent exterior scones, oven ranges, alarm clock equipment outlet for the way that was installed. They put in an alarm clock. Breaking
So I got a
down
question.
yeah.
Yeah, so I got a question for you. So what's going to be most common for a lot of local landlords, especially in California, given our rent control is legally under the law, we can vacate tenants to do substantial improvements. In other words, revamp a unit. So a landlord revamps a unit, and let's say they're hiring a contractor. So they don't have all the receipts for the quartz and the cabinets and the copper plumbing parts. They have one bill from the contractor that says, hey, $40,000 to, essentially remodel this unit. And they might have some general breakdowns. The contractor's charging them $5,000 for the replumb, 7,500 for the, anyways, big categories. Is it then the fact that this company comes in behind, or once the work is complete, and they're using general cost in the marketplace for each of the items in absence of actual receipts?
Correct. They're if you just did the improvement with an improvement, you want to give this company the data, and then they'll break up that $40,000 receipt into three categories. They're going
Okay.
to figure out what how much of that's 5-year property, like we just described in this section.
Hmm.
We're going to go into details to the 15-year property like this, of what's considered 15-year property and then what's considered 27-year property. The idea is to accelerate as much of this depreciation as possible in the first year.
Hmm.
So that's basically what's done. And you can see the spreadsheet with this house. There were 322 items that they broke down into granular detail. And that detail was then incorporated to be broken down into these three categories. What was 5-year life and what was 15-year life. So that way, in this example, we're able to accelerate 100% if this is done in 2025 after January 17th, $138,000 of assets that we'll be able to accelerate the first year. Whereas if this was done in a normal depreciation table, you're looking at a deduction of only $15,000. So it's a
Wow.
big number, right, to accelerate on the front end.
Sure.
But as you can see, it's pretty detailed. So and then they break down here per the rules. So like you said, Chris, this is all documented under the IRS rules and regulations, how they can break it down with those different um buckets of 5-year, 7-year, 15-year, and 27.5 year. So this is
Hmm.
not someone just guessing here. It's following specific regulations within the tax code to make it a legal deduction to accelerate all that depreciation in the first year or in the year you need it. Because for those of you who are on this call saying, you know what, Chris, Steve, I've never done this and I've owned my real estate for 10 years. That's okay. Because if you're going to have a significant event, this is the year to do it. For example, let's say you are retired and you're starting to pull money out of your retirement accounts, your IRAs, and you're going to pull out $200,000 out of a retirement account because of a required minimum distribution. You could do this kind of a study to book a $200,000 loss from the depreciation that you have. Then that loss can go right against your IRAs that you're pulling money out of.
Got
So
it.
even though you've owned your property for 10 years, so it's not a bad thing if you have not done it yet. It's just all about timing and being strategic of when to execute the study. Um, so what I'm going to do here, so when we were talking about the code section, what has to happen is it's going through the guides on the guidelines of estimating what items are deductible when, and also following through with all these rules and regulations that allow us to accelerate the deductions, as well as these court cases here. All these court cases you see is we apply all these rules to generate that report. Then once that report is generated, then there's a approach to segregate the costs. For example, we could also allocate indirect costs such as architectural fees, engineering fees, and permits to appropriate categories. And so here's an example. The engineer, if there's an actual engineer that's assigned to the property, it'll tell you the date of when the engineer shows up at that property, and then they'll inspect it. They'll look at it, and then they'll inspect it to figure out how to accelerate some of those categories. So per that spreadsheet, you'll see how it's all broken down here. We took that spreadsheet and they summarized it here with this report. So you can see that when they took those 300 items and they lumped up together the different categories of the whole house, of all the ceramic tile floor that was put into the house, and the aluminum downspout, the GFI outlets, and so
Hmm.
forth and so on. So it's pretty detailed. Look at even down to industrial metal shelving unit that was put into the property. So they were able to, based on the code sections, figure out how to maximize that category
Sure.
to so we can lump it all together and accelerate the deductions. And then on the engineering component, you'll see how they broke down the trusses of the roof all the way to the sheathing and the plywood of the roof. This is all through the computer, right? Where they look at based on the site visit, what can we deduct and accelerate? So this is going to go on. So in this example, we have all of these items here that are over a 27-year period that we can't get around.
So essentially, every screw is accounted for.
Correct. Every screw is accounted for. That's why if you're building a new property, it's a good time to let us know right away if you're building something new, because then we could really go down to not the rags, but what you're actually spending. So that way we can account for every screw. Because if the more we could put into this kind of a life, the more we could deduct in the first year, which is the 5-year category. And then you'll see we have pages and pages of the 5-year category. And then here, some of these are 15-year category, like landscaping irrigation. But even though it says 15 years here, if it's 15-year life, 7-year life, 5-year life, we can still take it in the first year under Trump's plan. But if it's a 27-year life, like slab concrete for the foundation, we'll have to take that over a 30-year period. So what's 27? What's 15-year life? Would be landscaping, pool, the swimming pool without the equipment, the concrete equipment pad, the paving for the driveway, because we all know that driveways get cracked over time, right? Pool decks always have to be replaced every couple of years. And then you have the architect fees that are indirect. And then you have general conditions related activity that's indirect. So that's all plugged in there. And then what they look at is what the real cost and insurance value is versus the depreciable basis. And they'll run the comparison to see which one, based on the code section, will maximize the deduction. So at the end of the day, that's how we create these reports to generate this kind of a write-off in the first year. And that's basically the detail of what takes place. Now, one thing I want to stress here, because of the LA fires, is when you do this report, it'll also tell you what it costs to replace your items with in terms of building it for replacement. It's important to read your policy and talk to your insurance agent too to make sure you have the appropriate amount of insurance. Because I can't tell you how many of our clients were underinsured because of what happened, the LA fires. And Kris, have you or your clients experienced any issues with loss coverage?
Yeah, I mean, different investors have shared essentially that the policies they carried aren't enough, so they're gonna have to pony up the cash to, pay the difference. And luckily, we're dealing with investors who are in the position to do so. But you can only imagine the homeowners, and so I've heard stories already of homeowners who, yeah, they get a check from the insurance, but it's just not enough, and there they are stuck.
Totally. And so one thing I want to add on that is when you get this report done, it'll tell you what the replacement costs are anyway for insurance value. So you can compare that to your policy to see if you're underinsured. So this is a good time to do some housekeeping to look at your policy. And so with the cost segregation, you'll see the benefit. Without it, over a period of 5 years, they would only see $60,000 worth of deductions versus 160,000 worth of deductions here with the study. So it is worth your while if you have an income event that's going to be occurring to take place. So here's an example of the property. They actually they walk through the property and they take pictures of all the equipment to put together their report. So it's here. Obviously, we want to look at the equipment, the stove and the microwave, etc. And then with the pool in the back, they want to take a picture of the engineering so we can accelerate that area of the deduction. And then of course you have your basic infrastructure here with the fencing and posts and the electrical panel that can be accelerated. So it's important to have all these details. And it also has to be done by certified engineers to make it a deduction, a taxable, a legitimate tax write-off. So that's the detailed analysis we want to cover today, Kris, to give everybody an idea that we can literally deduct and analyze the nail and the bolt going into the home or the apartment building.
So when is this not advisable? I mean, is it as simple as, well, if you're buying a building, it's a long-term hold, you don't have any significant taxable event. In other words, you didn't have a big windfall of income this year. That individual, are they still better off just going by the old 27 and a half years? Or no, there's more to analyzing whether an individual should, you know, accelerate the depreciation.
It's a great question. So if we have a one-time income event or pulling out money from other sources or inheriting money, it's a good time to analyze the when to do this. And also, if you sell a building and you don't want a 1031, you may want to accelerate depreciation on the other buildings you have to lower your taxable cost, taxable income. Or if you have a profit, if you're paying taxes on profit from your cash flow and you still have depreciation available, it may make sense to accelerate it. So that way you pay less tax on the front end versus paying it at equal amounts over the period of years.
What about properties that you already owned prior to the January time? You know, let's say I've owned the building for 5 years, and yes, I've been depreciating it, you know, small amount because it's the old rules. Are those properties available for bonus depreciation, cost segregation studies?
Yes.
Okay. Is there more to it than that? Or it's just a matter of, okay, we're going to do the cost study, the segregation study, cost segregation study, figure out what's available, figure out what you've already taken, so that part you don't get to, and then the rest of it we're going to accelerate?
Correct.
Wow. Okay.
It's a very powerful
What,
part of the code section. It's just a function of figuring out when to use it.
and what if you've had, here's a more technical, what if you've had a cost segregate, I'm asking this kind of selfishly, but what if you've had a cost segregation study, but now you've done more capital improvement to the property, and so there's new money that's been spent that wasn't depreciated in the first cost segregation study. Can it be amended, or what's the approach to that if you say, hey, you know, I dumped in another, you know, couple $100,000 into a property and that wasn't included in the first study because the work hadn't been done then? Is that available? Is it advisable? More to
It's
know?
available. So if you've already done it, but then you have a new equipment, you could definitely update the depreciate table with the new equipment to figure out what life it is under, which is the 5-year life, the 7-year, the 15-year life. So that way we could take advantage of the bonus depreciation versus the 27 and a half year deduction.
Very good. Okay. The
Yeah.
wheels are turning.
Yeah, it's great. That's why when you do your improvements, take pictures of what you're improving. And so that way, if you get a big blank invoice saying 40,000 total for improvements when you pay your contractor, it'll be great to break down what was improved. So we could break it down on the tax return for those different lives that we articulated earlier. So that way you're not lumping it all together to deduct over a 27 and a half year period.
If you ever felt like you're working hard, improving your property, increasing rents, managing expenses, and then writing a massive check to the IRS anyways, this is one of the strategies that can change that conversation. Cost segregation and bonus depreciation aren't for everyone, and timing matters, but for the right investor, it can be one of the cleanest ways to improve after-tax returns and keep more capital working for your portfolio. I've completed these studies on 2 of my personal properties, and it was a lifesaver, especially when it came to tax time. If this interview was helpful, hit the like button. It helps other apartment owners find this information. And if you own multifamily properties or you're working towards it, subscribe to the channel, turn on notifications. We're continuing to release more sessions like this covering taxes, financing, legal protection, market data, and the actual strategy behind building a financial legacy in multifamily properties. I thank you for watching, and next I would watch one of these videos here that will compound on what you've already learned. And until next time, this is Kris German from the Apartment Dealer wishing you positive cash flow, tenants who behave, and a financial legacy that you can be proud of.